Hello and welcome to this part of our trading course. So for this lesson, we're going to be going over an introduction to risk management. Um, so the risk management process typically has four pillars: identifying the risks, assessing the risks, controlling the risks, and then reviewing the controls. Now, this applies to anything, whether that's health and safety risks or trading risks. So let's start by defining what risk actually is. Risk is a probability of something going wrong or against what you expect it to. Now, trading is inherently risky, and as I'm sure everyone is aware, there is a risk when you trade with real money that you will lose money. It's just the nature of the game that you will lose some trades and you can lose money. You can also win money, but the risk is that you lose money. And in fact, you take risks all the time without actually knowing. So when you're going out for a walk outside, there is a risk that you get struck by lightning. It's a very small risk, very low chance, but there is a risk. There's also a risk when you're driving, you'd get in an accident. And that's a much higher risk. In fact, driving is one of the most risky things we do every day. Now, those risks are just things that we do. Now, trading is something we actively know that we're doing, so we can very easily control that risk. And risk management is the process identifying, assessing, and controlling the risks. So, how about risks in trading? Now, there's sort of three main areas where you'll come across risk in trading. The first one is the obvious one. The market moves in the opposite direction to what you're trading it, and you lose money. So if you're in a buy position, the market will move down and you're in the negative, in the red. Or if you're selling the market moves up and again, you're in the red, you're losing money. This next one, which is potentially worse because losing one trade or one or two trades is not so bad. It's what we expect because you're going to not be able to win them all. You'll always be losing some trades. Problem comes and the risk is that you lose multiple trades in a row. Now, when this happens, you have to make sure that you're not losing your whole account because there is a risk that you will go bust. Let's say you're trading with a risk on each trade of 20%. It only takes 5 trades to go wrong and hit your stop loss, which we'll discuss further in another video, for your whole account to go bust. So losing multiple trades in a row is a big risk in trading. The final one is if you make a mistake when placing a trade. And this isn't common, but if you don't know what you're doing, if you haven't spent the time to get used to the trading platform, or if you're rushing into a trade, you're getting emotional, your fear of missing out is coming into play. You might make a mistake, you might put the entry at the wrong level. You might put the stop loss at the wrong level. I know I've done this before, but thankfully, whenever I've done it, I've noticed it immediately and corrected my error. So making a mistake is a risk as well. That's human error. Now, it's really important with trading to know your own behaviors and know your own attitude to risk. Everyone has a different risk tolerance. So some people will be quite risk averse and some people will be very aggressively risky and risk takers. So the question you've got to ask yourself is how much risk do you take and how much risk could you take? So when was the last time that you took a risk? How did that make you feel? So it's an interesting one because risk tolerance really varies a lot between different people. For example, if you're going mountain biking, it's actually quite a risky activity, but it's also really exhilarating and fun. So you're accepting that risk because you know that it will make you feel good. And in trading, you're accepting a level of risk because you're looking at the reward that you can get, the profit that you might be able to make from doing the trade. So it's important to know your limits. how much loss can you take before that's it? That's enough for you. You can't take any more. And like I said before, there is risk. You have to take risk to get reward. And as Mark Zuckerberg has pointed out, the biggest risk is not taking any risk. If you don't take any risk at all, you're not going to get any reward. So you've got to have a balance, and you've got to find that balance. And actually, there are some really good little quizzes online that you can find, which will tell you how risk averse you are. So if you look here, you've got one I found on humanmetrics.com. Just took this risk attitude test, and I'm up here, so between moderate and high, and I'm a rational risk taker, which matches quite well with my personality. I'm a very logical thinker, and I will think through any decisions that I make before I rush into them. And this is good in terms of trading. You want to be towards the moderate to high end on risk, because you are taking risks, like I said, when you are doing trading. If we go back, so knowing your attitude to risk is important. And like I was alluding to there is a trade-off between risk and return. If you take a higher risk, there's a higher potential return, usually. And if you have a lower risk, there's a lower potential return. So in terms of investing, you might think of low risk as bonds, government bonds, and you might think of high risk as things which are quite volatile, which might go up a lot in value and might get you a lot of money, but at the same time, they could fall quite a lot. So cryptocurrencies would tend to be higher on the risk scale. In terms of volatility, if you're doing like an investment. But when we're trading, we don't think of it in terms of different assets being low and high risk. We've got to think of it in terms of our actual trading strategy risk. And that comes under the risk to reward ratio, and the percentage risk that you take per trade, which we'll go into in more depth in another video. So just to wrap this up, there's different ways you can control your risk. There's the position size, which is stop losses and the percentage risk. There's your psychology, how well you control your mind and emotions. It's diversification, making sure that you cover a wide market portfolio. There's that risk to reward ratio and position scaling. Now, these will be covered in depth individually in another video on money management, because these are all included in money management. So for this video, I was just giving you a brief introduction into risks and how trading includes risks. Like I said, trading is risky, but we go through risks every day in our normal lives. So it's just another different type of risk. And having that risk management process is absolutely essential if you want to be successful. You need to make sure you know what risks you're taking and know your own tolerance for those risks. So that's the end of this course section. Make sure to head over to our website and continue with the next part of the course.